Good afternoon. Welcome to Chicago Future of Finance. I'm Oliver Renick. Stocks trying to figure out what to do with a nice jobs print from this morning. That's the main story of the day here. Fits into the narrative that I've been offering, which is strength in the economy. And an underappreciated Fed chair in Jerome Powell. Why are we going to try and fix things if they ain't broke? Number pretty darn good this morning. Overall, the stock market's pretty calm. Right now, you got basically an unchanged market. The S&P 500 is up all of 10 basis points right now. SPX, we're trading just below 7,000 still, though very close to the all-time highs. They're still hovering around in this range. Looking at volatility, it's been uptrending in VIX. That line, watching it to see if it breaks down. Maybe we'll get a big pop if we can push through 7,000 with conviction. But it's definitely been horizontal for stocks, but very much at the high end of that horizontal range, which is encouraging, of course. Not so encouraging for the coiners. Bitcoin just flailing, under pressure again. Didn't even get back to 80,000, which was kind of what the chart seemed like would be the target for an upside bounce, a recovery bounce. Nothing. Strategy down again today, 4.5%. Is there a rhyme or a reason? As I've offered, pretty much any time we're below the break-even price for Michael's strategy, then it should be under pressure. But let's put that aside. The real story here is in bonds, which have maintained quite a bit of composure despite a really good number from the economy. The 10-year yield is below 4.2%. So far, that's been surprising to me. Now, my narrative about the economy being strong has fit, but my view on bonds hasn't quite lived up to what I thought, which would be deeper selling in treasuries. But I'm still sticking generally with my view that I've put on the risk radar, which is red for bonds. Just not quite getting the sell-off at this point. But the numbers seem like it should be coming. This is a really nice print at 130,000 for non-farm payrolls. Unemployment rate also dipping significantly. That's a pretty good look for the economy, I think. See the number here, just beating, smashing through expectations. A lot of it coming from healthcare services. Some folks say that's not the best place, but jobs are jobs, basically. And it seems like also a lot of the things that are going to get disrupted by AI are generally higher paying tech and software jobs. And I would think it stands to reason a lot of those people have equity built up, hopefully have savings, generally been in the higher paid cohort of the people over the last decade and the big tech boom, of course. The other thing, though, that I would point out is that the data from today just adds on to recent evidence of economic strength. The chart of the PMIs is very encouraging. Manufacturing and services both higher, with ISMs trading over 50. You're getting a real strong collaboration between both sides of the economy that we haven't seen in a while. So to me, all of that looks very encouraging, but yet it looks like we're still going to take the man out of his job, Mr. Jerome Powell, and replace him with somebody else, though there was a 5% chance on Kalshi yesterday that maybe Warsh will not be the nominee, so there's always that kind of Trump unknown premium. Let's talk about a different form of premium. Let's go to volatility with Mr. Brent Kochuba joining me from SpotGamma. Brent, we've got a market that I think is trying to figure out what to do with good jobs. Overall, pretty calm across the board, other than the crypto world, which just stays under pressure, it seems like.
Yeah, Oliver, it's rather remarkable because you are having what seems like a lot of dispersion. Software stocks, we talked about that a lot now. These crypto names seem very weak. You're seeing some of the financial-related names, the Schwabs and the Robinhoods of the world, getting beat up pretty good. And then you look at something like a VRT reported earnings. It's a big AI infrastructure name. It's up 16%. So you're getting a lot of movement around the fringes, I would say, of the S&P space. The mags are pretty quiet. And the S&P here is, 50 bips maybe from all-time highs, kind of at most. So That is the trade that we've been seeing, that single stock moving a lot relative to the index vol. And what I think is interesting at this moment now is that we're getting enough volatility premium in some of these names that it can justify traders who don't care about direction, but hey, there's enough VRP or vol risk premium in some of these software names, in like a Robinhood, in a Schwab, that I may trade that now as opposed to necessarily worrying about the direction. And so for that reason, I think we're going to see some stability in software stocks. I think we could see a little bit of a bounce in the short term here in something like a Schwab or like a Robinhood. Again, because that vol risk premium is likely, justifying a trade, of its own accord, as opposed to saying, hey, a year from now, Schwab is fine because its tax business is not threatened by OpenClaw or whatever the narrative is.
Yeah, no, I saw that story, and it definitely, I feel like, rings true. I mean, there are a lot of, for Schwab, for example, the way I described it when I was there, when I talked to Rick Wurster, the CEO, who kind of liked the description of it, was that it's kind of the Walmart of finance. It's got like everything you need, basically. That's kind of it's really a lot about conveniences. You've got every different type of tool that you could want. But if there are then specific now programs that people can use that are very cheap, that can be deployed by smaller businesses to target things that kind of chip away at some of the aisles of that Walmart, then okay, like it makes sense then to have some, price reconstruction, some depreciation. I think for the Robinhood, it's largely a crypto thing right now, trying to figure out what part of the business is going to slow down if crypto blows up. But to your point, a lot of the cloud stuff and the software stuff, I think, has been a very reasonable sort of competitive displacement. But it's also gotten like pretty extreme. Schwab doesn't have a lot of double-digit moves like it has in the last 2 days.
Yeah, that's right. And, it's about forward guidance and expectations. And, the rate of change of move on some of these things is big. I'll be honest with you, I didn't even know Schwab had a tax business. I mean, if you have your 401k there or whatever, it's something. And if you are, do you really want to switch your Schwab to some unknown app? And that app is probably going to get displaced by ChatGPT or whatever anyway. So all this is to simply say it's the rate of change that is shocking. You look at Unity, ticker U. That is a different situation, right? They make video games or whatever it is, and they have no defensible moat. There's not even any sort of like financial compliance, moat here. It's sort of like, this thing can replace. And the CEO had no real answer for that. I was looking at their earnings transcript, and the CEO had no real answer for that. And is that a name that deserves to kind of be down like this? Probably, right? But it doesn't have revenues. It's not a full stack financial firm, right? So again, it is a situation where the stuff that's getting punished right now with this AI narrative is real. And as a guy who's tried out the OpenClaw stuff, it's really great. It's cool. And so that is something that is coming. But like all things, I don't think it's going to happen tomorrow, but we're all sort of moving to this in the future. Now, on the flip side of that thing, though, I would just say, then why is like a Google and some of these other bigger box LLM, offerings are still down? They're not really bid at the moment either. So I just think there's some broad digestion and we need some leadership. But again, is Schwab going to go lose another 20-30% over the next month? With vol so high, I think it's worth taking a punt on selling some puts or put spreads or put flies or whatever it may be, trying to harvest some of that premium, because the vol premium has really jumped quite a bit. And if you look at something like an AppLovin or into, the vols are sky high in those spaces, and if they don't pull a Unity, then you should be okay. Making a bet that some relative calm starts to take over, right? Because a lot of these companies do have revenues. They are real. Their demise is probably not tomorrow. Is it 5 or 10 years from now? Maybe. Who's to say? But
look at I've got the implied vol up for Intuit, by the way, just surging. Yeah. So at a certain point, obviously, if you've been owning premium to the downside, it's been working. But the higher that bottom line goes, the harder it is to get paid if you have a directional bet on. Bottom line.
And not only that, if you're
paying up more for it.
100% right. And if you own puts and that line is spiking, you're incentivized to close your puts like if that line keeps creeping higher, right? Because that vol change, that implied vol, is a big factor in the value of your puts, not just sort of the stock going down. Sometimes it's even more important. So that in and of itself says, okay, selling puts here, if you're fortunate enough to be long them, makes sense. Not only that, when you go through earnings reduces implied vol, right? Just naturally. 9 out of 10 times that's true. And so that's going to reduce the value of these puts. If you can put this to work now and sell some type of straddle or some type of defined risk trade in like an app, it kind of makes sense here as you have earnings and you can bet that ball is going to come down. Now, if they put up a Unity, well, then you got some problems.
Look at Unity there. Vol, came in a little bit implied vol, but it surged right up into that report.
That's right. Now today's down 25%. That's no joke. So you have to bounce off that delta change, that price change versus the fall change. But the point is still the same. Some of these names are doing all right. Datadog reported, it bounced and it was fine.
Great
so
day.
I think vol premium trade is a good one in the software space, and getting a little bit of recovery, I do think makes sense. And if that software space recovers, that may be enough to sort of push the S&P back up into 7,000. And on that point, we have VIX expiration next Wednesday, OPEX next Friday. There's a PPI number tomorrow that some people are paying attention to. I don't know what PPI number has to come up for it all to matter. My assumption is that vol kind of contracts a little bit, and we got to start thinking about maybe a 7K pin or a move into that 7K area by next Wednesday in VIX expiration, and that's going to be the kind of next turning point, I think, for markets. Either a breakdown or a breakup. We'll have to see how things kind of play out for the moment. But I would think that realized vol starts to contract a little bit now as we move towards that VIX expiration.
Okay. The fact that the stock market has been able to maintain the very high end of this range, I feel like to me implies this breaks bullishly. I've been looking at this chart on VIX, which I like to just provoke people who get bothered by things sometimes, and those, you're not supposed to draw lines on VIX, but hey, it's been working. It's up and to the right. Like it's adhering to this thing. So it seems to me like if we get through 7,000, that could combine with kind of a VIX breakdown. But to your point, there are all these single stock stories that have to be resolved. But as we get further through earnings, because earnings push volatilities down, it seems like to me the timeline for this could set up pretty well, where the single stock vols come down now that the earnings are through. We threw out a bunch of the trash that's getting disrupted by AI, and then maybe VIX can break down. And it also could happen so that we don't have that big dislocation between index and stock vol anymore, because if they both break down together, then that would absolve some of that dislocation, right?
That's right. The vols are getting a bit cleaned up. There's still a lot of single stock dispersion, but to your point, these earnings come out of the sector that's been the most beat up. I mean, the software sector, maybe outside of crypto, right? But crypto is such a small market cap now as MicroStrategy works its way towards, I guess, zero. I don't really know where that eventually goes. But to your point, the vols now are a little more reset, and the Mag 7s are more interesting now. Look like a Google, it topped out at 350, I think was the high. It was trading at 330, I think, into earnings. Now it's at 310. Amazon's come back a bunch. Microsoft's come back a bunch. So those leaders are now more interesting, I think, than they were. You can see that they're on the Mags chart. Maybe you get some leadership back out of there, to your point before. I would think just in regards to the macro data today, I looked at CME FedWatch. It was pricing in 20% chance of rate cut and went to 10 after this morning's data. So there's some digestion maybe around that. But ultimately, what we need is some type of leadership, whether it's a clearer macro picture, a sector that we all want to move to the vector of bullish attack, so to speak. But we need something to lead us out of the breakout. And right now, that's not really in place. So I think it's more interesting is the vol premium in the software space. But maybe some of these mags are getting interesting, a la Tesla, NVIDIA up a little bit. But some of those names have worked off. So to your point earlier, Oliver, we've cleaned up some of the overbought sentiment. I think clearly that was there a week or two ago when we were talking about correlation spasm so much. And so I do agree with you that as long as we're above really the 6,900 level, then you kind of want to wait on the chances of a breakout. If we lose 6,900, then I think we got to start thinking about high 6,600s as we move through OPEX. So that's kind of the risk if you jump about a month forward, I think.
Yeah, to that point here, Brent, I got to jump maybe less than 60 seconds here. Just look at the gamma exposure, the levels you just mentioned to us. I mean, it seems like that kind of lines up where maybe folks will have to chase. Maybe we get a big market maker squeeze if we get out of 7,000.
That's right. Right now, everyone's selling calls at 7,000, and so that's offering big resistance. And as you can see, there's that blue positive gamma right around 6,900. So we're just swinging through that red zone right now. That's what we've been doing. I wouldn't think that's really going to change tomorrow. Maybe into the weekend, people start selling a little bit of vol, and we kind of finally move to that 6,950 to 7,000 area. But this is just sort of the effective range, right? And I think OPEX is going to release the range. Now, do we break to the upside or break to the downside? It's a little too early to tell. But for right now, I think it remains higher. I think, again, software stocks, if they catch a little bid, that can offer a little bit of support or a tailwind to markets. And again, the little bit of vol premium that's available, I think people are going to try to squeeze that for now. Now, again, if we lose 6,900, all that goes to the side, right. and I would worry about that extended downside. Yep.
Yeah, great stuff. All right, big moment here. Hopefully it resolves to the upside. Economic data seems solid, like we can support it. Seems like we could get vol and some of these earnings that have been wild to subdue, and maybe get index vol to subdue, and we rip. Thank you, Brent Kochuba. Appreciate it very much. Yeah,
Take care.
nice. So good look at the market there, in particular, as well as the key levels with the S&P 500 just so darn close to getting that 7,000 breakout. We're just hugging it like we really want it. Earnings have been the exciting story, though, of course, with a lot of the big moves. One that's been to the upside that I don't know if anybody caught it, but I know one of our guys did, Chris Brecher, joining me on the line here from TradingNest.tv to take a look at some of the big earnings move. What's up, Chris? Your stock Generac you put us on to a few weeks ago went absolutely ballistic, so I figured we should check in. Look at this thing. What exactly happened here?
Well, they came out not with the best earnings in the world, but they said that this whole power generation thing that people are going to need backup. So that was pretty neat. And that was sort of our, I did two crazy ideas for 2026, which I've mentioned in here before things happen. One was Generac getting taken over, and it didn't get taken over, but it went up $70. So that's pretty cool. And the other was that whole Kochuba stock thing, and those stocks have gone bonkers. If you want to look at Marriott or RCL, they have been really impressive. So that basket of Kochuba stocks has also worked.
Generac here, before we move away from it, this giant rip, I mean, as we were talking about, the chart looked like it was trying to break out from this long-term downtrend. How do you handle it when it makes a big move like this? So obviously, I imagine you're taking some profits. Do you then, hedge it out with something, or you ride the wave a little bit longer? Or was this, because here's the thing, with companies like this, where there's a lot of surprise on earnings, in particular after the need for power and some of the kind of idiosyncratic circumstances that drove the need for power over the last quarter. I mean, are they necessarily continuing, or is this something that is like a sustainable move?
Well, you called it when we were on last about that trend line. So, I mean, you called about, hey, if that breaks, it could go a lot higher. And the key to me was that little triangle above the trend line over on the right. But you were calling this as we were on live over right in there. So that's pretty exciting. Amazing. What do I think now? I think that, they said the same thing about Constellation Energy. And I mean, the stock's gone from 400 to 240. So it's definitely a theme kind of thing. But to me, I usually back away when a stock is that far over its 9 moving average. They just, you saw it with SanDisk, you saw it with ASML. It's just when this gets 40 points above its 9 EMA, it needs a period of rest just so the moving averages catch up. Okay. So, no, I would not initiate here. It doesn't mean I'm going to short it, but this is where you just got to get out.
Right.
I mean,
this is where you should have been watching us a week ago. No, good eyes on that, Chris. This is where you should have been watching us a week ago. Nice call, man. Great call looking at that.
Thanks.
Floor as well, another one that you kind of put in that same category. FLR still in this uptrend short term year to date with earnings around the corner. So maybe if you believe in kind of the fundamental case, you get a second chance. Give me the take on Floor real quick. Do you think that one could move like we saw in Generac? Is it tied to some of the same themes?
Yeah, it got to almost 50 today. And we're in spreads that we wanted sort of to sit here into April. But I think it's sort of sold off because of Martin Marietta getting nailed on earnings. So that's why Vulcan Materials went down and Fluor went down. I think Fluor's more of an infrastructure play than MLN. But I think that's why it settled down. But heck, that looks a lot like the chart in GNRC. It just doesn't move as much.
Right.
But theoretically, it could go to 50 to that high in December.
Yeah. All right. Well, nice look on GNRC. Floor TBD. We'll circle back on that earnings. I know you're looking at the banks and the financials, which got dinged up pretty hard today, Chris. I was looking at KRE as a real nice trade over the last several months as a leader in kind of the small to mid cap world. That's also taking a hit. Maybe we blame it on bonds with yields trying to move. But the thing is, yields came down over the last 5 days. So maybe this financial trade just needed to cool off a bit, or what say you? Because I was looking at a stock like JPM that was looking pretty good too. All those getting hit today.
Yeah, it's funny is you know how I know everybody is corny saying you got to trade what you see, not what you think. But I had no idea why American Express, Capital One, JP Morgan were going up when Bissett came out and he supported Trump's idea of a cap for a year on credit cards. But they kept going up. And it's like, that just didn't make any sense. The only reason I could think JP Morgan goes up as opposed to the credit card, the pure credit card plays, is you're going to have a lot of IPOs and that helps the JP Morgans of the world. But when you look at the real pure play like MasterCard and American Express, I had no idea why they rallied in the first place. So we shorted American Express this morning when MasterCard undercut its lows for the day. They correlate pretty well, and I like taking the most expensive in the group. And whatever that does, I sort of key off that to play another.
Okay. So you saw MasterCard getting weak, go for AXP. I do wonder if these are more kind of short-term trades because the numbers in the economy look good. Ultimately, that's a good backdrop for banks. Any thoughts on that, Chris?
I wonder just about the administration doesn't want buybacks and they want to cap the rates. So I just have to think, all of these are sells on rallies, even though you're dead right, the consumer's doing okay. But, I mean, they're already pretty high up as opposed to, let's say, last July. Yeah. I mean, they're up there. But I just think this just geopolitical risk is bothering these stocks. I mean, that's the way it looks to me.
Sure, some degree of unknown there to some extent. Well, hey, the big mover, I think, of the last 24 hours, maybe the most underappreciated one, was Generac on earnings. Nice eyes on that, Chris. Appreciate it. Always a creative take. Thank you very much, sir.
Yeah, thanks for having me on. Take care.
You got it. Chris Brecher, good eyes on the charts. Some of the underappreciated earnings moves. Maybe Floor will get the Generac move. 2-minute buffer break. Then we'll be right back. Got John Najarian going to join us. Take a look at some of the action in markets today and what's on deck for the next few sessions here. We're also going to get a deep dive into the options overlay strategies at Liquid Strategies for the Cboe exchange traded profile of the week. We'll be talking about a big competitor to the JP Morgan hedged equity fund and more. Market's hanging in there right now. The S&P 500 is still up on the day. It's added all of 1 basis point, basically, since we last checked. We'll be right back.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
There are 2 things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. Cboe is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about, the chance to fend for yourself, a fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Renick, from Cboe, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Hey guys, can you hear me?
All right, welcome back. We got stocks holding on here as the movement is small, but at least it's positive. Bonds have gotten a little bit more action at the 10-year up, and bonds down 20 bips. But there still is a pretty quiet session despite a nice beat in jobs. Let's talk to Mr. John Najarian on the line from Market Rebellion. John, what's up, sir?
It's all good, Oliver. Do you hear me okay?
I hear you good, sir. The market,
Fantastic.
I don't know, is it hearing the message about jobs? How come we're not ripping on this? Things seem pretty good in the United States of America.
Well, and they are pretty good, but as you saw and as you've been discussing, we had people looking at things like, well, the president's talking tough about Iran again. And so, of course, Brent and WTI, West Texas Intermediate, both went up. And they went up, of course, because what if there's a some sort of a disruption in crude oil transport and or production out of that segment of the world, that section of the world? That would be a negative. And it didn't take much. I mean, we were up 200 and some odd points, flipped like that, and now we've gone right back to the upside slightly, not the same. But yeah, I think it was a great jobs report. It certainly gave people a little bit more to digest after yesterday's retail sales numbers. We're talking about a different sort of economy than the one that today's job numbers describe.
You know, the moving crude, I'm glad you bring up, John, because there is a pretty interesting chart situation developing in WTI, which has been in such a reliable long-term downtrend that anything that threatens to violate that downtrend gets very interesting to me. I think it definitely fits the commodity trade that we've seen in the metals. It's just crude has been very slow to pick up because it's got all the other forces of U.S. production behind it that keep price subdued. But when I look at the chart, boy, it could get really interesting if it breaks $65. It feels like the last time we did that, we had a range all the way up to high 70s, maybe 80. Think that's something that could be possible if we start pressing the right geopolitical buttons?
I think it would be beyond that. I think we would need true disruption, not just these, not just these discussions. Not just
saber rattling, yeah.
Yep, that's well put by you. Saber rattling. These are, threats. They're certainly, I think Iran pays more attention to the president and his threats because of what happened, both with the attack back in December as well as the what went on in Venezuela. So he's not a paper tiger, but he does rattle that saber or, get people all excited. And then it usually just goes right back to normal pretty quickly.
Yeah, it's a usually pretty reliable rip to fade in crude. I would say among so many assets, it is a very reliable one over the last several years. I mean, I'm looking at the 3-year chart, the thing just every time very reliably dips off. And I think that's been helpful too. I think one of the biggest stories economically of the last decade is the U.S. leading on production. So it makes sense that there is kind of a call constantly being sold here.
Yeah. And, I think it's not the little boy who cried wolf. It's not, oh my gosh, there's going to be a massive disruption. It's just people price in. They use their modeling and they basically say, well, if this lasts more than a few days, maybe we see $3 or $4 worth of upside in crude, and then we better be ready to hit the exits pretty quick because the rhetoric will be toned down and so forth and so on. Is that what I'm anticipating? Yes. So I saw a bunch of back and forth in options on ExxonMobil and in Chevron that would, of course, tend to react rather quickly to something good or bad out of.
I guess I didn't even realize what was going on with Exxon, John. I've been sleeping on that one, I suppose.
No, I don't think you're sleeping on it.
I missed this one.
Yeah, it's always interesting. I was watching Royal Caribbean. When you look around at some of the largest places, the largest users of fuel oil as well as gasoline and Jet A, the cruise lines are right up there on the top of that list. And then airlines, of course, whether it's United, UAL, or whether it's American Airlines, whether it's JetBlue, any of those, you would expect that when crude rallies, those would go in the opposite direction. And indeed they have. Yeah. Again, United, I'm showing it down 2.5% today. A volatile session, certainly, but not a session where the whole market's heading lower. It's a few stocks in the Dow, NASDAQ's verged, and the S&P was up 5 just when I came on air with you.
I kind of like the idea of being long a United, which was just at highs, or a long Royal Caribbean, which was not quite at its highs, but in a multi-month uptrend, is a way to kind of fade the possibility of crude breaking out. Because when I look at the jobs data today, I look at the consumer spending number that was in there as well, and I look at what these companies offer, especially the cheap cruise. That's been one of the favorite ways for folks to indulge over the last 5 years.
Yep. It's been for cruisers that have internal combustion ice. Nobody wants more. Engines versus, and with that is the input that of coming down in price rather dramatically in the last 12 or 13 months since the president elected. I think we've got an issue where people would like to see crude oil continue lower. And they're likely to see that after a little bit of this, again, as you said, saber rattling.
Yeah, I'm kind of in that camp too, where generally whenever it looks like crude's about to do something big and bullish, it doesn't. However, the chart getting pretty interesting with this kind of like ascending triangle, if you will, that's been going on for some time in crude oil. But 65 bucks, we'll see if it breaks through there. John, a lot of people are watching the cloud and the tech companies around earnings. Questions in the chat today about potential blowback in the private equity world because of the software crash. Are you worried that this could become a contagion? There was a popular article going around on X as well, as someone saying this is like the beginning of COVID. Like, I don't know about that, you know? Like, all right, I'm not trying to be a jerk, but, you know, if you're getting displaced by AI as a programmer, you probably had a high-paying job before. Hopefully you got some equity. Hopefully, you know, you can, I guess you got to get creative now.
Right. Well, and creative is never a bad thing. And, you know, Pershing's on, and meanwhile he's on your competitors talking. He is not overvalued in the market.
Overvalued,
so
yeah. We're losing you a little bit, John, breaking up a bit there.
So
but yeah, a lot of these stocks were pretty expensive, right?
Yep, a lot of them are, and a lot of them now, because you saw Salesforce today was getting hit.
Yeah, Salesforce down 4.5%.
Space.
Getting rocked. Hey John, I might rip a chart. You wanna reboot your Zoom real quick so I can get you for 5 more minutes and see if that helps, because you're breaking up a little bit here. But I want to hear the thoughts on the trade for cloud, because you're right. I mean, I didn't even realize that Salesforce was down another 4.5%, just getting rocked. Fresh new lows. I mean, just absolutely obliterated. Now, if you look over the past 1 year, Salesforce down now 43%. So just absolutely brutal there, as we see cloud being the, coming off the chopping block in a very real way, being on it rather. IGV down 20% over the past year, also a pretty rough one. If you take it from the highs, IGV down 30%. Kind of interesting if you zoom out on the chart for IGV, still have this uptrend that's holding on for dear life, but obviously breaking here as we see the whole group come under some pressure. John, the potential for this uptrend, I'll try again here, for IGV, you know, the ETF that has a lot of these stocks in it, it's hopeful, but this is kind of the point that I was making, is a lot of these stocks are up a ton, and I know that's what you were saying as well, is that a lot of these were in the more expensive cohort of the market.
Yep, and people were justified to basically be nervous about those stocks and the valuations. And you and I talked about it when Dr. Burry was basically at the end of his rope before he basically exited some of his hedge fund practice. He was just early. Was he wrong? No, but he didn't give himself enough time to be right. And that's one of those things, Oliver, that when you're trading options, you do have to be cognizant of, okay, when is my projected move for, is it because of earnings, or is there a big conference? What is the reason? What is the catalyst for either upside or downside? And then give yourself enough time to be right. I think the number one thing that people fail at, whether they're trading at Cboe global markets where you are or any place else in the options world, they don't give themselves enough time to be right. They want to trade things like 0 DTE, 0 days till expiration options. And for the most part, there are very few of us professional traders that would say that that's a good idea. It's not for customers to be in there trying to manage a portfolio of very fast expiring options, whether they're 0 DTE or whether they're just 3 to 5 days. You want to give yourself a little more time. And some of the best of us haven't done that, and Michael Burry was part of that.
I think, too, if you're trying to bet on structural change, you kind of by nature, that doesn't happen in a day. And right. If you're thinking that these sell-offs also are creating longer-term buying opportunities, we talked about this with Pete yesterday, which I thought was a really good point, which is a lot of these companies, not necessarily the software ones right now because they're the ones being disrupted, but if we look at like an Alphabet, for example, that's been a big winner and pulled back around earnings. Maybe not the best example because it didn't come off too much, but a Meta that's off the highs, a Microsoft that's very deep off the highs. Microsoft's kind of one that sits in between, right? It's like it's spending on AI, but it's also has AI competition. But if you believe the stock is...
You don't need to look further than Oracle, my friend.
Okay, there you go. Okay, there you go, yeah.
You look at Oracle from last
example.
August when it made that 35% move, and you look and say, oh my gosh, the 52-week high is almost $350 a share. It is almost $200 under that right now. So when I look around, I say a stock like Oracle at these levels, to me, I'm just waiting for somebody to get an itch and start buying a lot of calls, and I'm going to be right with them.
Yeah, and that's where if a stock is hit because they're spending too much in CapEx, the market says they're spending too much in CapEx on a business line that's been proven, that's a long-term bet they're making. So if you're going to be trading it, you also have to have that in mind, right? That's going to be something that takes a while, to your point about not being afraid to own premium, which it seems like in time, rather, not being afraid to own theta as well.
Right. I agree with that. And obviously, people, when they get nervous, something a lot of people really understand, then they go for things like, look at this Generac move today.
Yeah, we were just talking about
Generac,
that.
I mean, from a generator. I'm not making fun of great business, and obviously where I live in Puerto Rico, virtually everybody has one. The grid is down here, but the ability that these guys use endorsement Generac and this big, I mean, at the was $140. $240. That's
literally from the low of 110 in April, doubled, kind of out of nowhere. Love it. Like the thoughts on the tech trades and the message on the long-term options. Appreciate it, John. We're going to get you a Generac backup for your internet out there in PR with the storms hit.
There you go.
You're the man, though. We got the message through the chop. Appreciate it, John.
Thank you.
You got it. John Najarian, Market Rebellion. All right, you see the stock market right there, the S&P 500. Now barely up on the session. 5 bips, make it 469.64. But as you can see, our weekly candle just hanging out right near the previous 2, which is right at the all-time highs. The pain trade is in the coin still. Bitcoin down 2.25%. That has come up a little bit off the intraday lows. And then now in the last kind of few minutes, headed back down. Looking at the bond market, which has been the focus for me on the session. We had that initial sell-off in bonds right as the number came out this morning, but then recovered into lunch before fading again. So we'll see if the bears push the bond market lower in price, higher in yield into the end of the session. But if I look at the dollar, which has also faded off the early morning pop from jobs, it doesn't look like there's a strong conviction in the macroeconomic trade today. What's working? Gold up 1.5%. Gold futures putting in higher highs still. An incredible chart here over the last 20 days that continues to find upward momentum even after the big sell-off. There it is. You got higher highs and you got higher lows in the chart of gold. And as John pointed out, a good one there that I missed is crude oil, WTI, up 1.5%. Ascending triangle potentially in crude that could break out. Also the move in XOM that John pointed out, that is an absolute beast of a move. So good eyes there on some of the energy trade. We're going to get to our bread and butter after a short break. Coming back, we're going to talk with the team at Liquid Strategies about overlaying options, not just on stocks, but on bonds too. A day where I think that's getting particularly interesting. with the bond potential for a sell-off very real in my mind. Shawn Gibson joins us from Liquid Strategies for our Cboe Exchange Traded Profile next.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
Welcome back to Chicago Future of Finance. It's time for the Cboe Exchange Traded Profile of the Week, the bread and butter, options and overlays. Joining me, Shawn Gibson is a founding partner at Liquid Strategies. Shawn, welcome to the show. Good to have you.
Thanks, OJ. Good to see you again.
Likewise, there is obviously a hot and competitive market for options overlays. You guys are some of the early actors in the space and have some pretty darn good performance to back it up. I want to start by talking about the equity world for the S&P because we're so close to all-time highs here. But we're kind of churning in this range. Is that kind of a scenario in which some of these strategies work, where you can kind of generate a little income while the market figures out what to do?
Yeah, that's exactly right. If you think about the overlay shares, they're really designed to generate extra income, a little bit of extra alpha, kind of in a variety of markets. So a flat market kind of plays right into our wheelhouse, rising market right into our wheelhouse. Even like a modestly lower market can often turn out to be a pretty good situation for our clients too. So yeah, absolutely.
One of the things that I'll just kind of cut straight to the chase with is looking at your guys' return next to one of the most popular, I think, kind of associations people have with this style of kind of equity hedging, which is the JP Morgan hedged equity HELO, which you guys have overlaid with your fund OVLH. You're kicking its butt over the last 2 years. Tell me how you're doing that.
Yeah, so really the key to OVLH, and if you think about everything we do, really, if it just kind of take a step back, kind of zoom back, is we take a lot of strategies that investors know and kind of love and really try to make them a little bit better. And I think OVLH is a really, really good example. So if you think about HELO is just kind of your basic put spread collar. So you're selling an upside call and you're using that cash to buy a downside buffer. Which can be a great strategy in certain environments, but the real trade-off there is the capping of that upside potential. So even if it is 5% above the market for a quarter, what if you have a quarter that's up 10, 15, 20%? You leave a lot of appreciation on the table. So the improvement that we made with OVLH is taking away that upside cap altogether. So we just outright finance those downside put options. We think it's going to be much more beneficial to our investors to just pay for that protection, manage that downside floor, and do it without putting a cap on the upside. So there are no calls being sold in our portfolio.
No calls being sold. Okay,
no
that's
calls
the key right there, because most people have that kind of collar on. You guys are not.
Correct. And so, the difference really shows once you have a market that really starts to take off is OVLH is designed to get more participation. With the trade-off being, of course, you're not generating that cash flow from selling those calls. So in a flatter type of a market, that sort of a structure may do a little bit better. But if your goal is to kind of maximize your upside potential while still having the downside hedge, we really like the OVLH approach.
Got it. Okay, that's very helpful, because what's been fun about learning about the different approaches to these overlay strategies is that, obviously there's a lot of different ways to do it. A lot of individual traders kind of have their preferred systems, but you can always make tweaks. You can shift your hedges. You can decide how much risk you want to take in either direction. You can very much kind of customize it. And I guess that's kind of answers one of my questions, which is sort of, the difference in these funds and what they do and who they apply to. If you think we're in a raging bull market, you're not going to want to cap your upside. If you think that we're going to be under a lot of pressure, then you might be interested in a fund that has more protection necessarily to the downside. How do you make sure, though, that you don't get torn up if the market does then come apart? You just still have that put down there?
Yeah, so for OVLH, there's always going to be the downside hedge component there. It's always going to be in place. We may actively manage it. So for example, if the market goes through our long put positions, we may actively monetize and harvest some of those gains that are in that long put, but there'll still always be that downside protection. So clients are buying it for the protection, so it's always going to be there. But we think it's very important during times of stress to be able to monetize some of those successful hedges.
How do you structure the downside protection? How do you know where to go and to what degree you need to protect? Does it vary, or is it always some fixed certain amount?
Yeah, so we typically start about 12 to 18 months out. So we do longer dated, and we do longer dated to really keep that kind of long-term cost down. So since we're outright paying for these options, we like to keep that cost down. And you could do that potentially by doing longer dated options. And they're typically set at about 10% below the market at the inception. And so what you typically see in our portfolio is as the market starts to rise up, we start to move the floor up with it to basically avoid having an air pocket. Because, if you have a hedge that's 10% below and the market's up 20, you don't want that hedge 30% below the market. So we kind of tether that floor to the market kind of as it's going up. And then, like I said before, market going down, that's when we start moving the floor down to harvest some of those gains.
Okay. Now, so if I'm, let's say I'm an advisor and I'm looking through your suite of funds and I'm trying to figure out which one to go for. You also have another one, which is OVL, right? Which seems like it's kind of similar but different, right? You have put selling option in here that generates income. So you still have an income component, but what type of, what's the difference between the client that wants that versus OVLH?
Yeah, so OVL is an alternative to cover call writing funds. So instead of HELO, it could be JEPI, for example. So it's designed for people who still want to generate that income. So in the case of OVL, it pays a 10.5% distribution paid monthly. So it's kind of this steady cash flow that you get throughout the year. But just like all of the overlay shares funds, none of them involve selling calls. So with OVL, you get that income, but you do it without capping any of the upside. So you actually have the potential to beat the underlying index through the option writing program that we do, which is selling below market put spreads on the S&P 500. So basically, it's really designed for people either looking to enhance their S&P 500 exposure, generate extra income, and that are willing to take the little bit of extra risk that comes with it. Because cover calls, you're protected only by the amount of premium that you collect when you sell the call. So it's really only a modest amount of premium. So investors in OVL say, look, I'll take all the risk and a little bit of incremental risk that comes from the put spreads in order to potentially get better returns and a higher yield.
Got it. But I guess if you are looking for bigger alpha in the trade relative to the market, and you are willing to take more of that kind of equity risk premium, OVLH would be more up your alley. Is that right?
Well, to maximize growth, you want OVL, because if you pull up the chart of OVL versus OVLH, OVL is not going to have the drag of the hedges that come into play. So if you're comfortable with the downside risk and you don't need those hedges to protect your equity exposure, you're going to get more bang for your buck out of OVL than you would OVLH.
Okay, got it. Now, how do you kind of figure out what other asset classes to apply this to? Because you guys are doing this in small caps, foreign equity, hedge large cap, but I'm very interested in the bond side as well, because I've got a personal view that I think bonds are going to get hit again pretty soon here.
Yeah.
So the bond part I think is pretty fun, because you're already kind of here, to some extent for income. But if you can, but if you think bonds are going to go down, then I would think the strategy would be really, really nice for you.
So so if you look at all the overlay shares, they all use that same option writing program that we've been using since 2013. So it's kind of a tried and true program that we've been running. And really, you can port that strategy and put it on top, thus overlay. You can overlay it on any asset class that you want. So if you want it on top of equities, you can get it. But so in the case of OVB, you're now putting that overlay on top of just cheap beta exposure in the form of AGG. So you're getting all the good and the bad of the ag, but now you get the supplemental income that comes from the option writing program. So now you all of a sudden you have a yield that could be, that right now is a distribution yield of about 6%, without taking extra duration risk. And so going back to your point, if you're concerned about interest rate risk and you want to shorten duration, what would be really nice is looking at like an OVT that has shorter duration. So you can move out of core bonds, shorten your duration into something like VCSH is our underlying, move into OVLH, which holds OVT, which holds VCSH, and still get a yield right now that's about 6.5% without taking that extra duration risk and without the credit risk that comes with things like high yield. So we have people replacing high yield with an OVT and an OVB, for example.
That's very fun, because I feel like that is definitely hitting into a thread of what portfolio allocators are trying to figure out right now, which is what to do with the bond side of the portfolio if they think that's going to be a problem. In particular, if they think duration is going to be a problem. This kind of gives you an opportunity where you say you don't actually have to get out of the asset class necessarily. Just use some of the principles that are more that are options based to hedge yourself out. And you can still keep the whole purpose of it, which is income, of course. So like the purpose of it remains the same. Hedge out some of the bond specific risk, and you don't have to make this big trade of putting a big chunk of gold in your portfolio or something, or arguably switching over to an equity based income, which might bring up different things that your team may not want, et cetera.
Yeah, because adding in like gold, it may or may not help, right? Like you don't really know, but you're kind of controlling your own destiny a little bit more here. We have some investors that we work with that are really cautious, not only about bonds, but also equities. And so they're actually looking at kind of like an overlay 60-40 where you can be like 60% OVLH, so have this hedged equity exposure.
I see, yep.
And then 40% like an OVT where you have short duration bonds can give you a really interesting profile, but certainly taking a lot of that risk down, both in terms of equity risk and duration risk.
I like that. Then combining them, right? Then you've got a real kind of sophisticated options covered portfolio that hits both. Love to see the strategy broadened out and ported across different asset classes. It's very useful to us. Shawn, thanks a lot. Appreciate your time.
Yeah, thanks for having me, OJ.
Good stuff. Shawn Gibson, founding partner at Liquid Strategies. 2:44 p.m. and the market is headed into the last 15 here. It's been a pretty quiet day overall. Taking us into the bell, Mr. Scott Bauer joining us on the line from Prosper Trading Academy. As I've been waiting for bonds to give us some action, Scotty, but I guess I'm going to have to wait a little bit longer. It's not, 20 bips in the 10-year future is not much.
No, you better wait a little bit longer. And I know you were talking about TLT. You want short TLT. I really thought that we would have gotten a much bigger move today.
Me too.
Especially with that auction, which came in. I think it was a pretty poor auction. It was not well received, and we didn't really see a big uptick. I'm trying to see where the 10-year is right now. You know, it had traded above 420 this morning, traded back down. I think it's
418.
418. So it rallied a little bit off of the auction today. You know what? You looked at the dollar this morning after the news came out of NFPs. Real quick pop in the dollar, and then it just sold right off. And it just sold right off. Right?
So, I was looking at the same thing, in the last hour and a half, trying to come back, but I don't know what else it needs. You know, that was a monster beat on the top line.
Yeah, I mean, I think we're literally just in this kind of landscape right now of sell the rip in the dollar. I mean, I don't remember another time that has happened like that, you know, outside of the last several weeks, maybe a couple months, maybe. But we are literally in a sell the rip of any dollar rally.
If the dollar stops going down, see, here's what's fun is does the dollar, if I connect this into the commodity trade, today crude's up, today gold's up. So clearly they don't have an issue with the dollar up 12 bips. But I do wonder if yields or the dollar go any higher, if it starts to put some pressure on some of that commodity trade.
It has to. There's no question.
I would think.
You would think. However, again, I mean, I think the prevailing consensus is we're not going to see that. Although I would say it's real interesting. This morning when the number first came out and we saw that pop in the dollar, we actually saw the gold kind of sell off a little bit. Not hard, not anything, volatile as we've seen over the last several weeks and months. But it did sell off before it started recovering, and we saw gold and the dollar really have that inverse relationship today. Obviously, not on a big magnitude of a scale, but as the dollar was selling off, we started seeing gold rally.
Yeah, to your point, gold looked like it was going to get hit early on in the session as the print came out. I guess just more, I've got the two next to each other right now. The spike in the purple is the dollar, and then the drop in the candles is gold. But the last kind of hour or two, it seems like one of them's got to pick a direction. Dollar's trying to, but gold's hanging on. It just seems like gold is gold, baby. It is hard to break that thing.
It is
hard to break that thing.
We've been talking about it. The buy the dip, just like the dollar is sell the rip right now. The buy the dip is still in place. Maybe it's not as easy of a trade as it was, a month ago. But I agree that gold is a buy on any dips.
I have someone who's. Hey, I wonder if he's watching the show. Someone was getting angry at me on Twitter about my crypto thoughts, and I'm like, dude, the numbers are the numbers. And what I mean by that is that, for example, when Bitcoin broke through 20,000 to the upside for the first time, I was pounding the table bullish. And I remember a bunch of coiners were like, all right, we'll sell you our bags at the old highs. I'm like, no, the technical chart tells us if it gets through 20, it's going to start ripping. Technicals I try to make sure technicals inform everything. And so the latest performance of Bitcoin versus gold here again, some people are coming out and saying, hey, Bitcoin's not gold. I'm like, well, I told you that from the beginning. It's because they'd have different things.
That's the narrative.
Yeah, and by the way, you don't really want.
We're trying to make for the last number of years.
It never added up. The way gold's trade next to real yields never looked like Bitcoin at all. And I don't even think you want Bitcoin to really be gold.
No.
You don't really. It's just they try to fit it into that because it's a big market cap. But lately, in particular, you're really seeing the difference between a risk asset and the difference between something that has now performed and held technically in so many different environments. Today just being the latest example, right? Dollar's up a tiny little bit, and gold's still hanging in there. Bitcoin's down again, just because apparently that's what it does these days.
It's really difficult. It is really, really difficult to decipher exactly what is happening. And we talked about maybe this narrative in Bitcoin and in crypto, maybe it has completely shifted. Not completely shifted, but it has shifted now. That it is really no longer that store of value. It is not, the end-all, be-all risk crisis asset that we thought it was. Now, I don't want to just say just because we're seeing a sell-off of pretty sharp magnitude over the last couple of months that takes away 10 years or whatever it is of this thesis out there. Something's broken, though. Something's broke. You got to make something of it.
The thing, too, is the strategy, MSTR, is like, I mean, look, we were talking about, I thought this thing could have found buyers on dips, at 200, at 150, but nothing. And to me, that's just a really bad look. But again, it also just fits because to me, the stock is a sell as long as Bitcoin is under the break even. It's so simple. This guy's whole strategy is buying something. If he's losing money on it, I say you sell a stock. It's like,
yeah.
If it's above it, I say buy a stock.
Until you can show me something else in their reports that says that they are either making or losing money outside of what Bitcoin is, I don't see how you can't be right about that.
Yeah. For BTC, the fact that this bounce didn't get us back to 80,000, I think means that we probably want to touch 60K and try that again to see if that holds, because that candle just hit it to the T and then came back. How are you reading the chart, Scott?
Oh, there's no question about it. We're somewhat range bound right now. I don't want to say that a range 60 to 70 is range bound because it's really not, but that is. I mean, it's got to retest that again, Oliver. And if it does, and if it bounces off of there, then I think there's more credence to say, okay, you know what? Maybe we have put in a bottom. Maybe we are near that bottom there. There's no question in my mind we are going to retest it. Is it going to happen tonight, tomorrow? Is it going to happen after CPI? If we get a really, really hot print, I don't know, but it's going to test it again.
Yeah. Someone in the chat says they are in the Kevin Hinks camp of crypto being a good measure of liquidity. I think that's like a close approximation, but I would say that we've moved towards the idea of more liquidity coming. If you think about the Fed and cuts coming, and Bitcoin hasn't responded. I do think its connection with the Fed is also has withered quite a bit as well. I think a few years ago that description might have worked a little bit better than it is, because we now have had a year and a half of stable monetary policy or cutting rates. Bitcoin hasn't performed, so I'm not seeing it as that liquidity. And by the way, stocks are at highs, so I don't know if the Fed cutting is going to wake this thing up all of a sudden.
Yeah, I agree with you. I think we're beyond that. I really do. I think you might see a short-term positive reaction, but again, it comes down to me that maybe that narrative all along of what Bitcoin was supposed to be has really started shifting.
Yeah. Scott, tell me about how you're seeing this kind of last chunk of earnings. To me, NVIDIA is obviously the main highlight, a couple weeks away. Chart trying to hold in. It seems like if the market really wants to break past 7,000, we're going to need some of the big boys playing again. You got hopes for that?
I have hopes for them, but right now the market is not looking that way. The market is punishing, absolutely punishing anyone and everyone unless we see the most outstanding report out there. So yeah. I think right now, big ones, the alphabets. As much as I love Alphabet, I am an Alphabet bull.
Yeah.
But I think you got to sell a rip there too until we get to a level, and that level for me in Alphabet is probably more like the 335, 340 level. So we get a rally back here, just because of the nature of the market right now, and just because of kind of the overriding theme right now that sector has some issues. I think you got to sell it at some point. That is going to turn.
Yeah.
I am long. Full disclosure, I own Google. I'm long it. I love it for the long term. But I think as a trade, you got to sell it on any rally, and I think that holds with a lot of the big guys. Obviously, NVIDIA doesn't fall under that category right now.
NVIDIA looks okay at 192. In terms of, but it's still range bound. It's still been stuck in that range. In terms of after the bell and what's coming up, Fastly, HubSpot, we got Cisco, I guess maybe one of the highlights for tonight. Cisco chart is boy, it's had a nice couple weeks. So if they take the same scalpel to Cisco, then heads up. Any thoughts on that one, Scott?
No, I'm pulling it up right here, and I can see it on your end too. I mean, you look at it,
monster.
You say chart's a monster. You say it's off to the races. What can stand in its way? And I can make that case for a lot of these stocks that have actually come out with decent reports, decent guidance, but the market didn't like it just because of where we were at right now. So I'd be overly cautious. I say that, and we'll probably see this thing rip to 100 or something. Who knows? But the chart certainly
that
looks
would
good.
certainly be the exception to the rule, because lately everything like Cisco that's looked like this in this category has gotten drilled.
Exactly right. I would say that there's a pretty decent line in the sand, and Cisco down about 10%, right around 77, 78 area, I think is the 50-day moving average, which has been a really, really solid support area here. And again, the market has a mind of its own, and they want to interpret the results any way they're going to interpret it.
Yeah. Thing too is, as a hardware provider, maybe it can kind of extract itself from some of the software disruption. But in terms of earnings calendars, I'm also watching for Coinbase too coming up, which could be very telling after Robinhood got hit today. Coinbase dropped with it. But boy, it is right near multi-year lows. So better hope that number doesn't disappoint, Scott. Or that's
that's another ugly one. That's another ugly one. And the market is pricing in the option market. It's pricing in right about a 10% move on earnings this week out till Friday, right about a $15 move or so. So that puts 135, 138 in the realm of possibility, maybe 170 on the upside here. For this thing to break to the upside, I don't even know what they could come out and say that's going to break this thing to the upside.
What signups on the Super Bowl commercial? I don't know.
Yeah, I don't know. I don't know. This is when I'm staying out of this picture until afterwards. I don't see a good probability of calendars, arbing vol against one another, and directionally, I think we're in the middle of no man's land.
Yeah, Coinbase desperately trying to hold on to multi-year lows at 150.
It is hanging by a thread.
Hanging by a thread, spending on Super Bowl commercials too. They kind of got roasted on a little bit. So, maybe they'll say something about it. But otherwise, for earnings, watch Cisco to see if it can hold on to the big run. And we'll revisit Coinbase into the earnings tomorrow. Scott, thank you very much, sir. Appreciate it.
You got it, man. Have a good night.
Scott Bauer bringing it home, Prosper Training Academy. Yes, sir. All right. Getting out a few minutes ahead of the bell here today. Thanks for tuning in to Chicago Future of Finance. I'll see you tomorrow, 2 p.m. Central Time.